Athens returned to the bond markets in April after a 4-year exile and is expected to issue debt again this summer. Chinese Premier Li Keqiang starts a 3-day visit today and signalled the Asian giant would be prepared to buy Greek government bonds when they next become available. I'm Sophia Aribo and you're watching Dukascopy TV. Joining me over the phone to discuss possible glimmers of hope for the Greek economy is Brian Whitmer from Elliot Wave International. Brian, in its annual monetary policy report, the Bank of Greece forecast that the economy will expand by about 0.5% this year. How positive a sign is this for Greece?
Generally speaking, I think it's actually a negative sign to see governments in general publicly acknowledging that this supposed recovery is underway. The reason I say that is government, we always find, is the slowest to recognize a trend, and this isn't just particular to Greece. I think all governments move by consensus, and they react slowly to trends. So from a contrarian point of view, if the recovery in Greece is so obvious that even government can see it, I think that economic growth is probably ready to reverse again. But keep in mind also there's an important caveat in that report that you mentioned, which was the Bank of Greece forecast the economy to expand if confidence in the country continues. And I think that word confidence is really important here because all of the gauges that I follow say that investor sentiment and confidence is already sky high. We're seeing yields collapsing on government debt. We're seeing investors buying junk bonds hand over fist. And, a lot of analysts look at these kinds of things and say, hey, things are getting better. It's safe to get back into the market. I see it totally different. I think the economy follows stocks. Stocks reflect investor optimism, and I think the European markets are about as dangerous as they've ever been.
The central bank has warned that there's no room for complacency on the country's reform drive. Can the Greek economy cope with any more spending cuts and or tax hikes?
No, they can't, but they're going to have to. Our models say that things are going to get quite a bit worse before they get better, and I'm basing that view on a few things. First of all, the wave structure in the Athens Composite Index. We use what's called the Elliot Wave model. That's our primary forecasting tool for stocks. And the Greek market has essentially been rallying for 2 years in what we call a wave 4 rally. In layman's terms, all that means is that once we see another top here in stocks, the market should go on to retest or probably even penetrate those lows from 2 years ago. And so that's important, again, because economic fundamentals almost always lag the stock market. So if our market forecast is correct, then we're expecting another final down leg in the Greek economy. And this is where we expect debt just to get completely repudiated, for asset prices to fall and get those sort of generational fire sales on all kinds of assets.
Greece is emerging from recession and April saw a return to the bond market. Has austerity been a success, Brian?
Well, I think all of the problems that existed before still exist. I don't think austerity has been a success. I think the deficits you mentioned are shrinking and the recession appears to be subsiding really for two reasons. Stocks are up and asset prices are inflated. Again, the same fundamental problems exist today that have always existed, which is that there's just too much debt in the system. If you look at debt to GDP ratios, they're at record highs. Non-performing loans are at record highs. Yet, like I said, junk bond sales are setting records again. So it's really this kind of optimism in the face of what I see as deteriorating fundamentals that has me worried. I don't think this is a recovery. I don't think it's merely 2 recessions. I think it's bigger than that. And the big thing that needs to happen is that debt levels need to come down. Debt has to get written off or defaulted on or repudiated in some way. And I think that process has certainly begun in Europe, but I think we're actually still in the early stages of that process of credit deflation. As far as where to be positioned in this kind of market, our recommendation is cash and safe cash equivalents. We really don't like the euro at this point, but we do like Swiss francs. We like U.S. dollars. We think that what investors need to be cognizant of is now is the time to sort of step aside, get in a safe position, wait for asset prices to come down, and then you're on the sidelines and you have the ability to take advantage of those fire sales that we think are coming.
That's it for now. Thanks, Brian, and thanks to you for watching.